this, another edition of our monthly webinar. And I would say that today's webinar is a very, very interesting and exciting session on SIF, which you all know is the specialized investment funds. And SIF, I would say, is a relatively new concept in India, and also in many of the emerging markets globally. And not many of us are fully versed with this subject and the intricacies as such. So friends, today we have with us Mr. Jatinder Pal Singh, who is the CEO of ITI Mutual Fund. And he will be sharing with us a lot of insights into this very, very special and interesting topic. So before I invite Jatinder sir, let me give you a brief of his work and the beautiful journey as a financial expert. Jatinder brings over 25 years of experience in the mutual fund industry. And prior to his current profile, he worked with Mahindra Manulife Investment Management as the Chief Marketing Officer. And earlier on, he was also the National Head of Sales and Distribution at Morgan Stanley Investment Management. And he has also worked with HSBC Asset Management India as Vice President and Regional Manager, Sales and Distribution. So a very warm welcome to you, Jatinder sir, to this webinar. And I'm sure today's web session promises to be very insightful and learning session for our audience here. So over to you, sir.
So thank you, Alok. Thank you for having me here on your webinar. I'll keep my language, my communication in Hindi and English both. And I've been told that we are all across India, so maybe primarily a little bit more English, but I'll use Hindi also, if that is okay. So thank you for the warm welcome. Thank you for the introduction. The journey of last 27, almost 30 years, I will say. Initially, 10% of that, 15% of that was in distribution, but rest of it has been in the on the MC side. So I joined the MC on the turn of the century. It was 1st January 2000. So a date which naturally I can't forget. I always tell people that what we were doing about 25 years back, SIF has given me that opportunity to relearn, refresh ourselves, and maybe share what we are learning in a new form again. Because this is a new product with some guidelines, new regulations, and new in many contexts. Though some people may say, look, I am aware a little bit about the product because this is what we have been doing on the alternate side. So what I'll do, without much ado, let me go into the product and talk more about that as much as I can. So, a year back, a little more than a year back, there were guidelines which came on the SIF. Now, SIF stands for Specialized Investment Funds, and the guidelines brought in a new concept which doesn't exist in long funds. So let me just clarify, when I use the word long, India's total fund management, which includes mutual fund, AIF, and PMS. I'm guessing that about 99% or maybe a little bit more is only long. The word short doesn't exist. Right? Now, there are a few people who may say, look, there are shorts which happen in arbitrage, in some multi-asset funds, in some equity savings. Yes, long short funds in category 3 AIF are there, but as I told you, they're like 1%. But what happens is in arbitrage or in hybrids like BAF or in some equity savers, you may short, you cannot short, remember. You cannot sell what you don't own, which is also called naked short. But in specialized investment funds, there is a power given, there is authority given by the construct of the portfolio that we can short up to 25%. So where does this come from? The background being that markets many times are inefficient, overvalued. So you, instead of selling what you own, some of this you can sell using futures options. That is, let's say using derivatives. You can take your positions in the market by short selling the product and try and make alpha or generate the money. Alternatively, I would also like to say that sometimes when we short sell, it may be loosely called hedge also. Now, if what I'm telling you is making little technical, maybe I'm being little technical, as I go along, I'll try and explain you. But the more important thing is, where does SIF stand? And in case on my slides you are seeing the word divinity, divinity is my brand, my SIS brand, which I'll explain you further. So for simplicity's sake and for portraying to you in right, we are using our own brand to place and explain SIF. So there was mutual fund which existed, and I'm taking post-liberalization period. Let's say it's been 30 years that it has existed about. I still remember that I was in the industry, earlier part of the industry. I had just completed my studies I completed my CA course, and we were studying when the first private mutual fund. And when I say private mutual fund, I don't mean UTI or PSU. The first private mutual fund of India called Kothari Pioneer or a Pioneer ITI Blue Chip Fund was launched. So since in the last 30-year journey, we have had mutual funds in various forms, mainly debt, equity, and something what we call hybrid, which is mix of debt and equity. Yes, somebody with a REITs and InvITs, all those have evolved, but still, mainly the products have been equity and debt. Then my guess is about 10, 15 years back, maybe 15, 20 years back, I'll say, a more customized platform called PMS came, which is Portfolio Management Services, and then AIF has also evolved. So they are all under SEBI. Here comes SIF, which says I am like mutual fund, and I also have a character of alternate. Why I'm not using the word PMS is because PMS cannot short. PMS cannot short sell at all. They can't do naked sales. In technically, when we use the word naked sales, in technical words, it is called unhedged position, which means I cannot take unhedged position in PMS because by power, if you have 100 rupees, you can manage 100 rupees. You cannot go minus, or you even then, even in your portfolio, you cannot sell in the futures what you don't own. You can hedge, but you can't sell. So it is more like mutual fund and some character of ARs, right? So let me just go further. How the construct has been beautifully done by the regulator is that regulator, since I had some interaction directly, we have been at the MT level talking about it, industry levels, many of the platforms, including FPSB, everyone has been involved in some kind of updation and education. The beautiful part of the regulator is that regulator gave a deep thought to it, placed the SIF under the umbrella of mutual fund. What does that mean? That simply means that only if you have, and I'm repeating, only if you have a mutual fund license can you apply for a SIF platform. So within the mutual fund license, you can apply for a SIF. So what? So now let me just change my version. Can AIF apply for SIF? Answer is no. Can PMS apply for SIF? Answer is no. Though I just said that even PMS or AIF has some character of SIF, but they can't apply. Now, whatever may have been the reasons, the best reason for the investors is this, that since SIF is placed, and I'll show you later in this slide, since SIF is placed in the mutual fund, there are many things which becomes beneficial for investors, which includes governance, transparencies, which includes taxation also. Remember, PMS has a different state of taxation which depends upon individual. The AIF is like mostly like business income, so you are almost in the highest slab, or if you are in, or at least in your marginal slab. But in equity mutual fund or in debt mutual fund, whatever is the taxation, and if that taxation has an arbitrage, then that applies to SIF also. So just to remember, and I'll show you a couple of slides later, I'll show you taxation also. Today, if in equity mutual fund, post in long-term capital gain, you are paying 12.5% plus cess and surcharge, then even in SIF, same rule applies. Although there is some alternate assets or AIF's characters already present. So So one more benefit of this is, if a mutual fund exists, naturally it has to exist. There is eligibility criteria, there is experience criteria that fund manager should be so much experience. The existence of the AMC should be n period. All that is criteria. Subject to that, if you get the approval, you need to nominate a CIO for SIF within the same setup, and you need to naturally, it's a scheme. Now it is a mutual fund scheme called as in the form of SIF. You need to nominate a fund manager. But other than that, all economies of scale or all the benefits of setup which exist gets SIF gets that benefit, which is compliance officer, risk officers, operation team, research reports, research team, you know, all that benefits is same. So let's say, for example, when I today we are at ITI Mutual Fund, we have 20 schemes. SIF is my 21st scheme. So we already had a setup. We had to employ a fund manager, right? But other than that, operation team, the fund management team, the research fund management team, all that existed, and all the reports, all the experience, all the talent out there is being utilized in SIF. Though we had to add some cost to it, but standalone, if I had to do that, the cost is much more. So did I need extra capital? The answer is no. The same capital requirement that is there for a mutual fund exists even for SIF. So well thought about SEBI, and I appreciate what they have done. Now I just talked about taxation. I'll take you through taxation. One of the most and the largest and the biggest differentiating factor, which all of us should remember for business purposes, for the purpose that there is going to be a shift towards SIF from many alternate and PMS and mutual fund schemes, is what you're seeing on this is on the screen. So, just to put it, what I just told you earlier, whatever rules you have learned about mutual fund taxation are the rules which apply for SIF also. So in debt, no extra benefit, whether you are in debt in AIF, you are in PMS, like you are in credit funds and alternate, all that, or you are in SIF in debt, the taxation is same. So in debt, there is no extra taxation, but in equity, in mutual fund, long-term capital gain is 20%, is 12.5% plus other charges. In short term, it is 20% plus other charges. In alternate, or when I talk about alternate, I'm talking more about CAT 3, because CAT 3 AIF can short, and they can short up to 100%. They can leverage 100%. They can go short up to 100%. Out there, if you are using derivatives, the business income tax can be as high as 39%. If you are doing any, and that 39% or lower, sometimes it can be little hybrid also, is applicable on transaction basis. So even in PMS, if the PMS fund manager is selling and buying, is selling securities, and if there is a capital gain to be paid, investor has to pay in that quarter of the year. For example, if in April my PMS fund, if I given money to PMS and PMS fund manager is selling a stock and I'm making money, PMS fund manager do not pay any tax. I pay a tax, and I have to pay the tax, let's say before 15th of June. So, or like, so no compounding in PMS AIF because it is transaction based and it has to be paid in that year. But in SIF or like in mutual fund, the pass-through benefit of taxation is there. If the fund manager is selling and buying, there is exemption. That exemption is under section 1023D, which already exists in mutual fund. SIF being additional scheme, but in the platform with some different rules, also gets that benefit. So whenever the investor sells the security, depending on long or short-term capital gain, if you are in equity, you get the same treatment as mutual fund. Now, just to explain this separately, because this is what I have been told by a very large AIF fund manager, a CIO of AIF. He told me that, JP, if I am managing, he manages about 20,000 crores of AIF money, and a lot of that is in long short also. He is paying 39% tax. So on and earning 15% gross. So if you earn 15%, in a scheme, and this is an illustration to make you understand, then if there is about 39% tax, so you are left with about 9.5% plus. And after expenses, you are about 7.5 or so, maybe 7 to 8%, depending upon what the expenses are. If I leave the expenses out, right, and why I'm taking expenses is in mutual fund, the NAVs which come out are after all expenses that can be charged. So just to take a ballpark, if mutual fund happens to give same returns, 13, 14, 15%, and I'm assuming 15 for AIF, 15 for mutual fund, after 3 years, mutual fund, if they earn 50%, that is about 13, 14, about 14%, about 15% compounding. If they do, they've earned 15%, 50%. Taxation will be at about 12.5 to 15%, depending upon your slab rate. So I'm assuming 13% is a round figure. In that case, about 44%, 45% is a net return to investor. But in PMS, sorry, not in PMS, but in alternate assets, AIF, especially in long short, when the business income, it is charged as business income, the net returns will reduce down, and assumption is it will be about 30% or so, maybe 32%, 32%, depending upon compounding, how that happens. So it's like 50% arbitrage approximately. It will depend upon various rates, periods, and so on. But let us assume that about 40-50% arbitrage is there. So what the CIO told me is, I am taking a license. The CIO does not have a AMC. It is an alternate AIF platform. They are applying for a AMC. They will apply for SIF and then think about whether they want to do mutual fund or not. So and why? Because they say, my distribution community, why should they sell AIF if I can't give a niche product? It is possible. For example, unlisted securities, PE funds, credit funds, or for that AIF is valid. For debt funds, AIF is valid because there's no taxation benefit. But if the same strategy is there, and if SIF can, the taxation can be explained very tangibly, the investor tends to move. You would remember how arbitrage fund, which sometime back were 50,000 to 1 lakh crore AMC, total AUM, have gone to 3 lakh crore. Why? Because the taxation benefits of about short-term capital gain 20% and other things are there. After debt, which got taxed at marginal rate, the arbitrage funds have benefited. So similarly, I think because of this, the initially cannibalization will happen. And trust me, it is not necessarily what you are thinking as a distribution community. The fund managers at large, the advisors on wealth counters who are already doing alternates, who are well versed with alternates, have understood that this benefit, if product being orange to orange or apple to apple, if the product is same and has a potential to generate almost same returns, then the taxation benefit is in interest of the investor. So we cannot take a stand against the investor. I know there can be some debate around the product. That is why I said, if apple to apple, if I take the product to be almost same, then the taxation benefit not being passed on to the investor through SIF means that it is a kind of then the investor should be aware about this product also. Now, already the industry is looking at, and it is the early days, looking at how SIF can be placed, provided the asset class is same. So I'm leaving this point out, can be debated in your questions if you want, right? So how does the industry, what has the industry got? Currently, industry has got 3 categories and 7 total schemes that we can launch. Though everything has not been launched, some might not be beneficial right now, will come up later. But just to elaborate for all of us, 3: equity, hybrid, and debt. There are 3 categories. Equity, 3 funds can be launched. They are on your screen, right? And the most prominent ones are going to be the top 2 names. Equity long short fund, which we have launched also. We launched the second equity long short fund of India. Right, at ITI, we launched the second equity long short fund of India. But currently, Nothing has been launched in sector rotation long short fund, and I'll explain you why also later. So equity long short fund has been launched, I think by now at least 4 or 5 people. Equity X100 has been launched. Now can't remember the name, but I know I2 has launched. I know 1 or 2 more people launched. So at least 2 or 3 of them have been launched. Though you may ask me why we have not launched. I'll explain you later. And on the debt side, uh, nothing has been launched. Main thing being that these are long short funds. If the market does, if in case market do not have the depth or the volumes to do to cover your positions or to do shorts, or another word for that is also swaps sometimes. So what is, and the whole idea of launching then is defied in the mutual fund industry and in the AIF. The debt category is quite well positioned. We are liquids and overnight and shorter versions and longer versions, and there is no tax benefit. Rather, the credit funds, which post a bad event in the industry many years back, got reduced. The AIF has taken over that part today. Maybe selectively, or that way they have taken over that part better. So nothing has been launched in debt, and I think it will be. I can't see a reason where I can come and tell you that invest in debt funds in the SIF in the form they are in today, until unless the market gives me the opportunity of covering my positions or shorting or hedging my positions. I don't have any reason to tell you how to do it right now. So my guess, long time before somebody comes up. But even if somebody comes up, my guess it is better to be in mutual funds or in AIF than be here, right? And hybrid. So hybrid, there are two categories in the two kinds of schemes we can launch. But hybrid needs to be explained, which I do now, right? Because hybrid, now we know hybrid means equity and debt, but this needs to be explained, especially in the SIF category. So right now, the funds that, to my knowledge, they have been launched are in equity long short, in the equity X top 100 long short. Now, equity X top 100 means small and mid cap. 65% of the portfolio in X top 100 has to be small and mid cap. Remember, many years back, I think it was 2018, SEBI banned this category in mutual fund. So mutual fund has large cap, mid cap, small cap. It has large and mid. It has multi and flexi. It does not have mid and small anymore because the category has been abolished. There was a category before that that has been abolished. But in SIF, SEBI has given this category in the name of Equity X Top 100 Long Short Fund. By the way, whatever you are seeing on the screen, this is going to be the name of the fund. So Divinity Equity Long Short Fund, Divinity Equity X100 Long Short Fund. The full name has to be written. It is not going to be something else. These are the name of the schemes where you prefix your fund house and you launch the schemes accordingly. So today in equity, long short have been launched by the industry. Equity top 100, X top 100 has been launched by the industry. And I think in hybrid, long shorts have been launched. I think only one active asset allocator is going to be launched. But there is a problem out there. I'll explain you a little later why. Right. So while I'm on the page, let me finish the sectoral rotation long short fund. The sectoral rotation long short fund means that you intake your positions in sector specific positions, just like business cycle fund in the industry. Out here, this is sector focused funds, and you can call it business cycle fund, right? So I'll tell you the problem. The problem is, if today I have to short or hedge other than Nifty and other than banking and financial index, other than Nifty index and banking financial index, no other index has liquidity or volumes where mid cap is just starting, small cap is not there. So the question is, if I take a sectoral rotation fund and I launch it, how will I short it? How do I cover my positions? So that is why I think we will have to wait for some time. Maybe somebody may launch just to record, for just to build up the records for future. In my house, same issue exists in equity X top 100. Reason being that if I can't hedge or short, and when I say that, I'll explain you what I mean. There are about 230 or 240 stocks which can be traded in derivative section. Right? Naturally, I've already talked about Nifty and banking and so on. They are index, but I'm talking about stocks. Few stocks, very small number of stocks are in small cap category. Then there are many in mid cap. And somebody may say all 100 large caps are in FNO. The answer is no. There are few which are not there because there is a criteria to be in FNO, and few of them do not meet it. So if there are 230, 240 stocks in the FNO, and by our calculation, beyond 120, 130 stocks, the volume dip, the depth is not there. So whenever so there can be a huge spreads, or maybe we can't even take position. So in the long short funds, the idea is about risk management equal to performance management. It is not only performance. So reason what I'm trying to explain you is, if you are in mutual fund, right? So everything is long. So if market falls, your portfolio falls. Market rise, your portfolio rise, right? Hardly anybody uses cash for hedging. And even if you are, let's say you want to use cash, which is you have to sell your portfolio. If you have to sell your portfolio, then market experience says it will always be mostly it is against you, because if market rises and you are in cash, right? So you cannot just go and invest fast in that. So generally, market doesn't utilize cash as a portfolio strategy. Remember that in COVID, market fell about 38%. Even hybrids fell 25-30% that time. Equity fell 30 to 50, 45%. So, but in long shorts, the idea is about downside management, about trying to do downside management, about trying, the effort out there, because there's a philosophy which I'll explain to you after this. So I'm stopping on this category right now, right? So, and just to close before I go ahead, in the hybrids, do not take all hybrids to be same. Reason being that I'm explaining that in the next two categories, next two slides. Within the equity categories, or let's say globally, I would put it generally, and this is very broadly I'm putting it, there are subsections and subgroups, many may be there, but generally the this SIF category is, though a diluted form of the AIF, it is mostly referred to as hedge fund category. Within the hedge fund category, about 40-45% of that is like what we are referring to as long short. So it is about $4-5 trillion industry now, which has more grown in the last 3.5 decades, and maybe I can explain a little later how the growth happened. So broadly, there are two kinds of fund management out there. First is what is referred to as directional or view based. Our Divinity Long Short Equity Fund is directional or view based. So what we do, we build portfolios. So essentially, we are equity fund. But the philosophy is to manage downside. So I am not saying downside protection. Remember, this is not a guarantee, but this is about being aware. This is about having in your DNA. This is about having in your blood that you have to manage downside. Because if you manage downside, if you can manage downside of the market, then automatically the volatility or the risk adjusted returns of your portfolio comes down. So one, directional or view based, right? And second, maybe I can come to this if you need explanation further. Second is what is referred to as absolute return. Now, in many of them, I'm not saying all, many of the hybrid long short funds in India are in this category. So what does absolute return mean? In India, there is a category called arbitrage. What does arbitrage fund does? We are all aware. They will take delivery of the stock and sell the future of the stock and try and generate spreads out there, जो हम हिंदी में फड़ बोलते हैं, तेजी मंदी जो कह देते हैं पुरानी भाषा में, right? So they will, and arbitrage is earning, let's say, just for example, 6% per annum. Maybe sometimes they're 7, 8, sometimes they're 5 also. So let's say they earn 6%. So what the absolute return strategy is that the arbitrage funds are there. We will try and be arbitrage plus. So if arbitrage is 6, they may say I'm 7 or 8 or 9, which is arbitrage plus or arbitrage plus plus or maybe arbitrage plus plus plus, something like that. Let me give you a disclaimer in the initially. There is no free lunch. So if there is anybody says there is plus, there has to be risk. And risk is, don't be perturbed by the word risk. It simply means that to generate something more, I'll have to take little bit more risk. So little bit more risk than arbitrage. There can be open positions. There are many people who will say covered calls and all that, all those things. They are only part of the strategies. But net thing is, what I want to explain you is, you have to, as an advisor, as a financial consultant, as an MFD, you have to learn not the categories anymore. You have to learn the way of management. You may give up your money of your investor to a hybrid long short fund and maybe learn later that this fund may only earn fixed income kind of returns, 7, 8, 9%. Right? But they have a taxation benefit, no doubt. So, and there can be another hybrid long short, which is directional, which is like BAF or like, multi-asset fund. I'm just taking a name, not including gold and silver, but they may be like equity saver, they may be like BAF, equity and debt positions, but open positions, but directional views on the stock. So for example, and this is just explanation, please check, please do confirm with whatever you are selling, when you are choosing a product. And since I'm using the name, since this is an educational class, I'm using the name of my competition just to explain you. I have been on meetings and I have been on planners and platforms with some of the fund managers. So Altiva from Edelweiss, their hybrid long short is a arbitrage plus kind of a scheme, which basically means that they will try and generate, and just using the word, please don't take me as a salesperson or on their behalf. I'm just using little more freedom just to explain you. Maybe they'll try and earn 7, 8% or something little bit more. Like SBI Magnum, Gaurav is a good friend from the industry. Bhavesh is from Alteva, from Edelweiss. So they are also absolute return strategy. So whether they are 9, 10%, whether they are 7, 8%, that time will tell. And I'm sure you are already following those. If you are following the NAV, you can follow the strategy and returns. But what I'm trying to explain you is, they are absolute return. They are arbitrage plus. Sometimes it is possible on a shorter term, they can be negative, but not very huge negative returns. So like arbitrage fund, where you can expect that month to month, you may earn 5, 6, 7%, depending on spreads. Out here, there can be a month where, volatility may come in, and that happened in second half of January, in February it happened. And in March, remember, March was double-edged for both sides. Any positions were rogered in March, right? I have not seen a month where you start a month with such a good view that Europe trade deal happened, budget is okay, USA trade deal is done, which was hanging sword for us, and then March comes and 10-11% of the Nifty goes down, right? Every day the news on politically based, oil prices going up, war happening. Every day you take a position today, the position is against you next day. So it is not that markets fell throughout in one-sided. It fell, recovered, fell, recovered, recovered, fell, recovered, fell. This is what was happening. And when I'm saying this, you know what the news flows are all around. So those kind of months can be bad. This is not a surety that every month it is same like arbitrage. Arbitrage is the best example. But just cutting it short, even within hybrid, you need to learn that there can be arbitrage plus. The more plus are there, little bit more will be there, but there can be directional. So when I explain my scheme, I'll use my example of my scheme to explain you what I mean directional after that. So now I'm coming toward the philosophy of these funds. So philosophy goes like this, that maybe in the Western world, after they developed and they grew and their economies grew, the interest rates came down. Now there were investors who would be thinking that, look, interest rate is down, I need to earn a little bit more. But if I go to equity, the risk, volatility, uncertainties of equity are more than debt. Can there be a product which is aware about risk and try and manage my portfolio, keeping risk in mind, but if possible, also delivering market returns? Now, market return does not mean Nifty given 15, you have to give 15. Market returns means you can take a directional call, right? And maybe I'll give you few explanations or example later. Now, a lot of the things I'm talking about are for learning purpose, right? So here, this is how this some bit of the source of the or the platform for long short funds came in. Remember, SIF, we are using the word long short, though unhedged position can be only 25%, but this is how the platform to set up this kind of a long short funds came in. Natural to the market, early days, the institutions, the ultra HNIs, they tend to take these positions more, but now this, at least in India through SIF, this is more retail. Because remember, AIF, 1 crore is the minimum investment amount, PMS, 50 lakh it is, and here we have to be 10 lakhs, which I'll talk about features later. And the rule of the management of SIF should be downside management. So yes, it is not possible, or it is not, maybe it will not be completely true if I say I know what to do in every situation, but it is about awareness. It is about person managing long fund and person managing long short. Now you may say, isn't the long fund manager more aware or equally aware? My answer is yes, but it is about way of management. It is about DNA of management, where the long short fund manager has to be, need not be, maybe they will not be before time or on time in the party. They may leave the party, and when I say party, it means party of the market when returns are being generated. If they feel that market are overvalued, they may tend to leave the market early or hedge the position. So what I mean, hindsight bias is the most foolish thing that we can talk about. So what do I mean by that? September, October 2024, market is 26,300. Nifty I'm talking about, right? So how actually 26,000, everybody gung and said, "Sabko badhiya hai, 30,000 hone wala hai." But when markets come down over a period of time, right, mood changes. But that is now how long short should think about. And when I say long short, I mean that directional long short. Remember, the arbitrage plus or the or the or what we call the absolute return fund are not directional. They are trying to generate return in that range, maybe 6, 7, 8% or something like that. Let other people who are managing give the return for themselves. But that is what they're supposed to manage. But for people like us, right, and maybe people like Quant and iProve, whoever launched, right, and many other funds, we are the directional funds. So what we are doing is at 26,000, maybe before 26,000 we'll take up positions. So do not look for last day, last mile returns in this long short funds. It is about risk management. The belief is, if I manage your risk well, and when market dips, I manage your downside well, automatically in this cycle, over cycles, we will be able to give you decent returns. It is not a question of somebody told me, can you give me the highest returns? So I may end up. Why should I lose the confidence? But the question is not that. Question is about management. It is an anomaly, remember. For 30 years, for 26, 27 years, I have been in the market talking about long, long, long. And now comes long short. Even sometimes we get confused. Sir, how to place it? And if you are hearing me or you're hearing anybody in the recent 1 year, confusion is there, right? So what I'm trying to clear is, returns is matter of results and processes and time and factors and other factors. I am talking about the philosophy of management of long short funds. Long short funds are supposed to manage risks. If they do not do it, then why are you coming to SIF? Go to long only. इफ यू आर लुकिंग at मार्केट ऊपर मार्केट नीचे, मेरा पोर्टफोलियो ऊपर पोर्टफोलियो नीचे, तो आप वहीं रहिए ना लॉन्ग में, क्यों आना लॉन्ग शॉर्ट में, क्यों दिमाग लगाना, क्यों सर्टिफिकेशन 13 करना है, क्यों जाके एक्स्ट्रा पैसा स्पेंड करना, अपने एफर्ट डालो, नॉलेज लो, और उसके बाद चाहिए लॉन्ग फंड ही मेरे को। नो नो नो, SIF is about risk management equal as much as about portfolio management for performance. So Warren Buffett is quoted on is very clearly, if 100 falls to 60 to go back to 100 has to earn about 75-80% more. But if 100 I can manage the fall, even if I rise less, I will be able to manage your portfolio, right? So I can assure you one thing, the joke in my office has been, like God who is remembered in bad time, only when the market falls, long short fund will be remembered, provided the fund manager and the person who's managing has the philosophy that, look, their work is downside management also. Nothing a surety about this, but I'm clarifying the DNA of management is little different. It may look confusing for the first conversations you may have, and it will be confusing even if you go to investor. But the smart investor is already reconciling. Otherwise, in the world, this category would not have been $5 trillion. All the big, the unique names of fund managers you are hearing here nowadays are coming from long short side, barring Warren Buffett of today. I'm talking about, right, Peter Lynch and all that. Like, he retired much earlier. So many people who are you're here now are long short hedge fund categories, and they are doing well also. And remember, the day markets mature, and the 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 capability of outperforming benchmarks will become difficult. These funds will try and do, maybe they can do better, especially risk adjusted returns. So let me go a little further, and maybe if I'm taking more time, I'll go a little faster now, right? So why I'm using this slide? Because this is about education of SIF early days. Why do SIFs have a different name than mutual fund? Why could not my SIF have been named ITI Long Short Fund? Why have we named Divinity? No, this is not my choice. This is not that I decided. This is what SEBI said, regulator said. You have to give a different brand positioning, and for 5 years, first 5 years from your launch, you can co-brand it. So my name of the fund is Divinity SIF, offered by ITI Mutual Fund or brought to you by ITI Mutual Fund. For 5 years, you can co-brand. What's the reason? The reason is that these funds are differentiated products. They can take unhedged position. Which basically means they may carry a little bit more risk. Although the objective of the fund is to manage risk, but still they may carry risk. So, mutual funds have been in vogue for 30, 35, 40, 50 years. The UTI has been there for 60 years. One bad day, one bad time should not impact what you have done already. So, to ring fence the mutual fund industry, these schemes, though part of the mutual fund, have to carry a different brand. So, if and these are initial days till investors become mature and understand. So that is why a rebranding exercise was done. Now, to put it very differently, example I use so many times, if you want to buy a expensive Maruti car, you will go to Nixa and not Maruti showroom. So Maruti has created that. As a customer, you had no issue going anywhere, right? But Maruti said differentiated product, luxurious product, expensive product, I will give you differentiated service. Similarly, out here, differentiated product, so assumption is it may carry higher risk, can manage risk better, but at the same time carries little risk. So less ring fences. That is why the branding everybody has to brand differently. So we use the word DIVINITI. It is a synthesis of divinity, divine plus niti. Niti is the Hindi word for planning, and you are aware about Niti Ayog and Chanakya Niti and all that. It comes from that word. And divine is the wisdom, the integrity. So it is a synthesis of two words. We said divinity, DIVINITI also we put it, though maybe being little over smart in that. But whatever be it, my name is cleared. So my fund name is Divinity Equity Long Short. If I launch hybrid tomorrow, it will Divinity Equity Hybrid Fund. That is what is going to happen. right? So similarly, you are already aware. I told you about Altiva. We talked about Magnum. Old brand SBI. We talked about maybe Tata has a titanium, and ICICI Pru has ISIF, and so on. And I'm forgetting. So the new names even I don't remember everything. So Mirai has got approval but not launched. I think they are platinum, right? And I think Templeton just launched of I can't remember the name. I think Arudhya is there from Bandhan, and Apex is there from Birla. So if you will have to remember a few of this, but ultimately what I believe, you will shortlist the funds and maybe concentrate there. This is what I believe. Shortlist the fund which will meet the objective of your investors. So going to the next slide. So I've already talked about it. I'll not go into this. It is about mitigation of downside impact. It is about hedging, rebalancing. Yes, this is in this fund, the activity level is very, very high. Right? Sometimes you will see that the turnover ratio of this fund can be very high. Right? Sometimes you in Hindi में बोलूँ आपको लगेगा सटोरिया तरह है. It is not so. It is about managing risk. Right? I call this fund as वो herd mentality होता है ना. जंगल में जैसे मैं जब पहली बार गया था तो मेरे को बताया गया था. So when I went to the jungle for a safari in the initial days, I was told that at the slightest noise, expect whether or not tiger is there, expecting that the monkey will make a noise and deer will run away. The herd mentality. At the slightest noise, all the birds will. If you put a cracker out there, all the birds will fly away. So partly directional view-based fund managers take that kind of positions that look, if I think there is a noise or early signal of risk, I will take my hedge positions. Ultimately, if I can do that, it is not about being always in the last mile, best and worst. It is about being trying to manage risk. So I am what in the last half an hour, 35, 40 minutes, what I try to tell you is about risk management. Do not forget it. Do not mix it with others. You will be challenged also the way we are challenged today, right? But it is about downside, trying to mitigate downside part of the market falls, trying to mitigate or reduce the volatility. Volatility will be there. So out here, we are not trying to be God because and say that we know when to do what, but we are trying to be more aware, more active than the even more proactive than the active. So it is possible. It is not necessary that what we do, strategy will play out, but it is again I'm repeating downside. It is about downside management, right? So next slide I am showing you is a very key component of directional based or view based funds like us. So what is this slide telling you? This slide is giving, and we have picked up example of how we have managed our AIF during the recent years. Remember, just to tell you, we have a AIF. So ITI has a long short fund, which is about 8 years old, 7.5, 8 years old. So I'm using a part of that journey to explain you how we managed in this part, and that is what you should expect from view-based funds. This is what is referred to as asymmetric return. So, around October 2021, market reached a nifty level of 18,200. Then it fell. We had Ukraine and Russia war and so on. It went down to 15,200 also in the May of 2022. But from early 2023, markets start rising. And for the next almost 1.5 year plus, markets went from about, I think, 16.5, 17,000 nifty level to 26,200. Last top that you saw, not the January or February top, last top you saw was in October of 2024. So markets went up by 42%. Nifty, I'm talking Nifty went up 42%. The long short AIF that we managed went up by about 45%. But the thing is, 3-4 months before that 26,000 top, our fund managers started building hedge positions. They say, look, market looks overvalued. It looks before time. It has gone before up more than required. So we will build our positions so that in case there are corrections, we may take the downside. So 5 months from October till February, Nifty fell 15% from 26,000 to about 22,000, right? So in that 15%, our fund fell 3%. Hedge positions or short position. So for the first 3 months, you won't believe, first 3 months, October, November, December, when Nifty fell 9 to 10%, we fell 1%. And then naturally, so what was the reason for, in the last stage of that rise, we may have underperformed, very natural. Markets go up, and we say we want to be covered. That is the ethos or the main principle of management of long shorts. If you are not managing it, then you are another long only. Why are you using the word short? Why have you taken a license in name of short? Then, so, and in January, February, when markets were 10-12% down, we took our position, we started uncovering. So that is why from 1 to 3 we went down, and there is no hurry to undercover. So basically, there was no hurry to uncover. So basically, when market went up 42%, we went up 45%, market fell 15%, we fell 3%. Total market went up. You can see on this slide, market went up 22%, we went up about 39-40%. So it is the total cycle that you have to see, how it is to be managed. Now, this has all the characters. It has character long, it has character short, it has a character of PMS in mutual fund and alternative. At times, it may just be fully covered kind of a debt fund. Kind of, when I say debt, I mean debt character of a fund. No equity exposure, completely long short. Long short means arbitrage fund. Remember, what is arbitrage? Arbitrage is 70% long, 70% short, trying to make 5-6% returns. Out here, if I do that stocks to stock, I will be covered and I will generate a fixed income profile kind of a return like what we do arbitrage. And that is why the problem is talent pool is low, experience is low. So we will, as an industry, this is what would have happened 30 years back. We have generated that, we will generate here also. I'm happy to tell you that we have a one fund CIO who's been 18, 19 years in the long short, 30 years in the industry, 8 years with us, who's overlooking this side of the business also. So this 7.5 years, and I'm using this our own performance to explain you how the nature of the fund can be. You are seeing 4 bubbles. The bubbles are when the markets fell. So I'm taking the period of COVID. I already talked about that. When COVID market fell 38% on Nifty terms, our long short fund fell zero. Zero means zero. Maybe it was 0.5% up. 0.5% up because it was hedged and we generated some return. Why? Because 1 month, 1.5, 2 months before, fund managers started saying, look, if there is COVID, and sometimes we have forgotten what COVID is because we have passed that period. Everything is shut. My work is to manage risk. While we will laugh around, अरे हिंदुस्तान में भेलपुरी खाते हैं, पुचके खाते हैं, गोलगप्पे खाते हैं, हमको क्या होगा, हमारे तो अंदर ऑटोमेटिकली एक फाइटिंग स्पिरिट है मेरी बॉडी के अंदर क्योंकि हम ये सब खाते हैं. This is jokes that we are passing that time. When the COVID hit, everything was over. Market fell. This fund did not fall. It was flat. That is what you're supposed to do. Now let's say I have already explained in the previous slide about this. The 4th bubble is this. Markets fell 15% Nifty, 20% mid cap, 25% small cap. This is what market fell. Our fund fell 3%. Right? So it is about risk management. And if you see the ratios, it is differentiated beta, Nifty, and since Nifty is our benchmark, Nifty will always be 1 beta, we are 0.3. Right? So expected beta is like 30-40%, maybe 50% of the Nifty. Can we try and generate returns which are early double digits or near Nifty? That is what our endeavor will be. This endeavor, not a promise. That is what we have been. In the long short AIF, we have given about 13-14% CAGR. It may be close to 14, can't remember exactly, but this market is dynamic, keeps on changing, but approximately 13-14% CAGR is what we have generated because the NAV is 100 rupee, NAV is like 270, 80, 90 rupees, that is what we generated. So what is the placement? How do we place a product? Let me tell you rules of SEBI. If you are equity long short, you have to be 80% invested, right? Actually, if you ask me, this is high number, but who knows, this may change later. but you have to be 80% invested. That's first rule. So maximum 20% that you can do. Unhedged, you can do 25%. Unhedged is short sales. But important thing to notice, what SEBI has allowed is that SIFs can be 100% hedged, which means I'll take this slide to explain you what I mean, right? And this is our way of management. First of all, we think this is simulation. We think we will be between 55 to 75% invested in delivery-based equities. Remember, I have to be 80% invested. Remember this part, right? I cannot be. We are not. We are essentially equity product, but we are not juggling around futures always. Every month roll over. No, no, no. So we will buy securities, large cap, mid cap, some small cap. Remember, we are like flexi cap, but more large and mid cap, some small cap. We will buy those securities with 1-2 year view. Maybe sometimes it may be tactical call and take positions. So 50 to 75 will be invested out here. 55 we have taken for explanation's sake. Right? It can be 60, 65, 70 also sometimes. If I'm 55% invested, I have bought equity delivery, then where is 45? 45 will be in sovereign bonds, right? Whether GSEC or T-bills or TREPS. We are not, this is equity fund. We are not sitting, we are decided not to take calls on corporate spreads for anything. Because if we do that, there is some restriction. I'll explain you later if we are time. So 40, let's say 40-45% of my balance portfolio is already earning me interest, whether 5 or 6%, whatever it is. T-bills may earn me little bit more, TREPS may earn me little bit less. If I take a GSEC call, although they can be mark to market, but that can earn up to 7% for 10 years now. I'm not talking right? So 55%. Now go what I written on the slide. First column is if I am bearish. If I am bearish, what I did in COVID, full 55% invested will be 55% short. Short means hedged. If I bought 5% Bharti, I'll sell 5% Bharti. If I bought 3% ICICI Bank, I'll sell 3% ICICI Bank. This is the reason we are more in large mid cap. Go back to what I told you 15 minutes back. If I can't hedge, how will I manage risk? So that is why we are more large mid cap oriented, because top 120, 30, 40 stocks have some volume on FNO. If I don't have volume on a day I want to hedge, then what is the point of being long short at all? So you have to be aware about risk before and not after the risk happens. So 55% long, 50% hedged. We are zero position now. And I can take minus 25% if I want to. And I can do 25 since I am explaining bearish, we can be minus 25. So what will be the net position? Net position will be minus 25. Net position will be repeating minus 25. 55% long, 55% short, zero. And then minus 25 because I have gone unhedged or done short. Still, don't forget 45% of my portfolio is lying in debt securities, which are earning 5-6% for me also. When I am long short or I am dead, if I am long short, it is arbitrage fund. I learn 3-4%, some maybe 5% out there. So some portfolio will be fixed income that time. Now there is a surprise for you. If rule is that 80% I need to be invested in equity, but I've been telling I have 55, 55, 55. Where is 25? Short is also called in the gross exposure. Short is a position you are taking on the market or on the stock. So short is equal to a position only. 55% long, 25% short is 80% gross exposure. This is what bearish is. Fast forward to the right hand side of this slide. If I am bullish, right hand side is more bullish. So 55% invested, constant number I'm taking. Maybe I'm 75 that time, but I'm just taking constant number 55. And I will buy futures, rest. Why should I be short? I'm not negative in the market. So I may be like 90-95%. But when I'm 55 in my delivery base, 45 is still in cash. So cash means T-bill. So how do I buy future? T-bills earning me interest. I buy futures by pledging my T-bill, not by earmarking cash. So they can be pledged and as margin, and futures can be bought. So we use more of future. I'm sure somebody may use options, all that. But what I'm trying to explain you is just example out of what we are doing. So my potential range, bearish can be minus 25, bullish can be 1995. We cannot go above 100. When I say unhedged, remember 100 rupees given from you, I cannot take my gross exposure above 100. Upside 100, downside I can be minus 25, right? Minus 25 through shorts. So I can be 0 and then minus 25. So offhand that I know, nobody has made this kind of a portfolio positioning or till now. That is what I am aware. Maybe somebody may have, I'm not privy. Only few funds have come up till now, right? So these are all risk management things. I'll ignore that. Just to come to features, 10 lakh minimum required for any SIF. So first time you have to be 10 lakh, then you can even give 1 lakh rupees additional checks and all that you can even give. SIP allowed. We have put 5,000 rupees minimum. Somebody may say 25, but we have put 5,000. You can give a 10 lakh rupees, 11 lakh rupee check and get a 5,000 and above SIP. SIP is same like mutual fund. KYC norms same like mutual fund. This is mutual fund only. In AIF you have to do documentation. Here you don't have to do documentation. But separate portfolio will be created, separate statement will be given. But when you do download services for your customer, even if customer wants customer mailback services, Divinity and ITI Mutual Fund both will show. So basically, if the customer is invested in mutual fund or invested in SIF, both will show in the mailback services, the services you get. In your portfolios, like distributor portfolios, you may use, you use many softwares, NSE, BSC trading, everything is like mutual fund only. Only thing is, since branding is different, name is different, but it is a mutual fund scheme. And in equity fund we have kept daily purchase, daily redemption like mutual funds only. And my rule is, since I have 30 to 45% cash with me, so what do I have to? I don't have to sell anything. I have cash. I'll just fund the redemption somebody gives. So why do I have to bother? So we have just kept a little bit exit load, but but maybe other people have also kept, the days may differ, but repeating daily purchase, daily redemption, and T+2 funding just like equity mutual fund. The only differentiation being, if you are in hybrid, you can do purchase redemptions only 2 days. Mostly people have kept Monday and Wednesday. That you need to check with people who are having hybrid. And it is possible that some equity fund may not give daily, but I am aware till now that everybody is giving that. What I'm aware till now, right? So do check this on. Please do check this. So SIP, I told you, systematic withdrawal facility is also available, like what we do in BAF and aggressive hybrid. What is not available today, temporarily, I'm saying only temporarily, is switches from mutual fund to SIF is not. It is not by regulation. It is just that at MFI level, maybe somebody decided this switch for the timing is not there. Maybe they'll allow it. If switch can't happen, then STP can't happen. You can't put STP in ultra low duration liquid and do into SIF. Maybe one day this will open up also. So what I'll do, I'll just stop here. And disclaimers, everything. I'm sure you are aware, but risk profile. And just one thing, this slide I kept for a reason. The risk profile of my scheme may differ. So we may be 5, we can be 2 on a monthly basis. My last month risk profile was 2. When I started, it was 5. Reason being, if I'm covered and hedged, the risk is not there. So automatically this will change. Remember, the riskometer was made for dynamic positioning of the risk and not absolute. It is not absolute. Remember, if my risk is less, so for example, in March month, riskometer is still to come out. So riskometer is out for March. My approximate average position for March was 15%. In March, Nifty fell 11%, we fell 3%. So my position in March in my SIF was riskometer 2. So because we were hardly about 15-20% net positions, we may on a day we could have been 30, 40, 50 also, but average was like that, right? And naturally, this are disclaimers that all of us need to be aware. So what I'll do, I have many slides, but I'll stop here and maybe summarize what I just said, and then maybe if you have put questions, maybe Alok can prepare to take the questions. We can take the questions. So just to tell you, specialized new funds have come in. They are called long short funds. They're little more category. This category. Let me explain you with a example that has become quite famous in the industry. The example is that if you have heard about a childhood story called Cinderella. Cinderella went to the party where Prince wanted to marry, was looking for a bride. She was sent by a fairy godmother using the magic. She got dressed as a princess, got carriage as a princess. But there was one rule set by the fairy godmother, and she said, Cinderella, come back before 12 o'clock, 12 midnight. So she had to manage one risk, only one risk. She had to come back before 12 o'clock. But as the story goes, and I believe that is the reality of life, you tend to enjoy more near that risky area only. When the market is 26,000, when the market is 18,000, when infrastructure funds are at 100, 200 P, when all those things are expensive, you have made money recently. So you think everything is gung ho. You are in La La Land that time. So Cinderella was enjoying the music and the party, everything dancing around when the music was playing. And remember what in 2007-8, what this global CEO of Citibank said: if the music is, we have to dance till the music is playing, which basically means the liquidity is there, we have to be invested. But this is not what SIF is going to do. Then what if this is what long short is going to be, that you're going to be long and try and go away from the party at 12 o'clock when you already know risk is hit? Then you are not a long short fund manager. So what I want to put in your mind is long short fund managers are supposed to leave the party a little early and maybe come to the party a little late. This is a feature you may keep in your mind. Do not try to say, market बढ़ गया, आप तो बढ़े नहीं, market गिर गया तो आप possible नहीं है ये, right? But still, कोशिश
I,
बाकियों से ज्यादा रहेगी, लॉन्ग से ज्यादा रहेगी. So what I say, I stop here. If you had you given me more time, मैं और भी बात करता. But I think एक घंटा I could summarize whatever I could summarize. I tried. Alok, we can take the questions now.
yeah, brilliant, sir, brilliant. Actually, so much of material and so much of info in your presentation. I mean, it was really wonderful. So, and especially, the example of Cinderella, I think so aptly put by you. So I have a few questions from the audience, and then I also have a few questions from my side also. Is that the common question what I'm seeing is definitely around, one is what kind of investor profile is most appropriate for SIFs in the Indian context. So in your view, I mean, what kind of investor profile? See, our financial planners, when they go and they have different set of, some are handling HNI, some are handling non HNIs and all those things, ultra HNI. So what kind of investor profile is most appropriate for
Sure.
SIFs? Is
So,
there any, I
so
mean, for that matter, is there any investor profile which is most
yes,
appropriate
there is
also?
surely a risk profile there. So what I'll do, let me be practical first and then
Mm,
theoretical later, right? Because
mm.
ultimately, for for the business purpose, practical is more important. Uh, I would say that first of all, let me put the rules to it. In this is a product which should be looked from risk-adjusted return side. Maybe people over the absolute return, and I am learning from them. It's not my words, right? So what they will say, how if they are in absolute return, then they will say if they're 12 months, 18 months, judge me by number of months I have given positive returns, right? So out here, first of all, in long term, this is the expectation should be that volatility of the fund, a well-managed fund, a fund where the philosophy of long short is being managed, is being kept in mind, will be lower. So what I have seen is that last 15 years, 20, especially last 10, 12 years, as risk and volatility went up, the HNIs, alternate HNIs, family offices, institutions, they tend to be more aware about these products. So sometimes when my due diligence is being done, I'm we get I'm I'm overwhelmed when somebody asks me, tell me about risk first and performance later. Performance is available democratized. Risk समझना पड़ता है, right? So this is about risk-adjusted return. When you are placing the product with the investor, if you have already placed long product mutual fund, this will be like a new paradox for him. He are long short. So, but
So,
whatever, this is insurance for bad days. Remember, in today's market, volatility and risk is not over. Just because market went up yesterday and today, market recovered, it's not over. At 124, I can't see whether risk is over. I can't see yield going up 7% risk is over. I can't see things settling down. And lastly, is the market undervalued? So I'm just giving an example of current market. You will find these things. Then in portfolios who understand market are okay with decent returns but lower volatility risk. People who want to move from hybrids and people in PMS and AIF where taxation is higher, for them this is an apt product, right? Even if it's
right.
same to same product, you can. I am not saying move or cannibalize. Don't take me in a negative sense. I am putting
Yeah,
the
yeah.
reality and practicality, which is going to happen. You don't do it, somebody else will do it. Or the day the investors are aware, they'll do it. It is already happening
So,
with us. I have AIF, I have SIF. Already one child is being challenged by the other child. Both are my children out here, right? So placement will be that way. And in future, I would say as people are moving towards 45, 50, 55 years and going near retirements and so on, do more allocation out of
so,
the funds.
do you see SIF becoming a kind of a bridge product between retail mutual funds and high ticket AIF?
Yes, and somewhere I will say this is a bridge for retail moving to alternates. And I don't mean AIF, I mean understanding alternate asset class. But for alternate or HNIs who are already understood, this may be more like a arbitrage in terms of post-tax return. They already know the product.
Okay. And so then, as a planner, Jatinder, I mean, how should we evaluate the performance? Given that the SIF strategies, they may not be tracking standard benchmark. You showed that Nifty 100 TRI. So how should planners evaluate the performance then
So
of these
I know I'm
SIFs?
being recorded, so that is why I can't tell you something. But I'm the only
Mm,
equity long short who has Nifty 50 as benchmark. Everybody accepted. I did not accept it, by the way.
mm,
Exactly what you said, I told when I was in conversation that there should be no benchmark first of all, but
mm.
but appreciate that there should be something. But if let's say if I am, for example, yesterday, I don't know about today, but yesterday I am 30% only open position. Nifty is 100% open. So how do you judge me? And that is where I need to. So out here,
That's what,
the
yeah.
difficult work, but good you are talking about this. All the planners have to ultimately have a conversation with the fund houses after hearing me. Look, I gave you a presentation as if I have learned this part of the craft. And if I was sitting on your side or the planner side, look, what is
Mhm,
it that needs to be told to me? So I have become a
mhm.
Dhurandhar double agent for you all, saying, I know this part. Any you like, I would explain
Uh,
you without hiding anything. So whatever you
yeah,
learn, put those questions to those fund schemes and houses, right? Over period of time,
correct.
and if like for example, I can't take the names, but a very big hedge fund manager who sits in Singapore in March said I was 75% open position. So what? So 75 open positions okay, but you can't be arrogant and say so what, right? I'll
Mm,
cover it later. तो तुम long short क्या कर रहे हो? Long ही करो ना, सौ ही कर दो. So what? And you can say so what instead of one so, right? So all I'm trying to say, if I'm not aware about this, I should not be managing long short, right? This is not just कि भगवान ने कोई देन दे दी है. Look, I remember a very senior person early days wrote an article saying that God has gifted. These are my words, by the way. I'm just using the sense of what he heard. God has gifted the industry with a new product called SIF. When market goes up, they will make the highest return. When markets come down, leave said falling, they will earn more by shorting. look, the extreme views, this cannot happen. You God ke bahar ho gaye ho. God is also trying to do this, not successful till today. Right?
Correct, correct.
These are lies. Let me tell you. This is
That's very much part of the game, JP. Actually,
this is
you can't
misleading.
avoid it. Yes.
Misleading.
Yeah.
Thank God this is not happening anymore. Maybe we all have
Yeah.
realized this. And this
Correct.
is
No,
what
I have a very,
JP
yeah,
was very cautious about this. This is a mistake least none of us should do. So place it
correct.
rightly over a period of time. All the planners will understand. They are all intelligent. They know, and they will. Then what will happen. They will make positions or automatically where to place. But today, what I try to do, view based, directional based. But are you hedging? Are you doing risk management or absolute? Do in a period of last 3-4 months, absolute may have done better. Market
Mm.
gira hi nahi unke liye, bada hi nahi unke liye, right? But when the market goes up, they will still do 6-7%. I may do just not confirming, but I may do 10, 12, 15%, 20% also, because I am taking a view on the market. So you rightly said, when our planners are positioning that, so maybe early days they will automatically start fitting कि देखो इनका ये fund है, and then place accordingly.
So I have one more practical question, a very short question, which is like, so okay, it is understood that 10 lakh first investment and all is fine, but then can future SIPs be of 5,000, 10,000 to this?
Yes,
Is
yes.
that
If
yeah?
you give me 10 lakh rupees today, then you
Mm.
can give me SIP of 5,000, 10,000. But active breach cannot, by active breach means by redemption, you can't go below 10 lakhs. You can give me additional SIP, yes.
Okay,
But
so
you
that
can't
10
just
lakh
give me
threshold has
SIP.
to be there.
But you just cannot give me SIP of 10,000 and say, look, in next 7 years, I'll become 10 lakh. That future commitment can't be there. Once
Mm.
10 lakh is given, so tomorrow if I have 3 schemes,
Mm.
fund house level, PAN level, 10 lakh. Maybe you give me
10
10
lakh
lakh
each.
today, then you can new
Mm.
scheme, you can give me 2 lakh also.
Okay, sure. Thanks. I have some more, but I think in the best interest of time, I think we will mail you some questions, JP, in case you
Anji,
can, if you find some time and let us
Anji,
know.
Anji.
So Sanya, over to you for concluding. You are on mute, Sanya.
Okay, I'm visible, right? Like I can
Yes, yes.
not see myself actually. Yes. So
You are.
that's great. Like as we come to this session, and I could see that how engaging it was in your presentation. So thank you for sharing your valuable perspectives in this part one of our series. And thank you, Alok sir, for moderating the session and taking the Q&As from us, from our participants. And to all our dear participants, thank you so much for your active interest, and we truly appreciate your time and presence. So as mentioned, this is the first part of our two-part webinar series on SIFs. So we'll be seeing Mr. Jatinder again, probably in mid-May, with the second session where we'll be diving deeper into the topic.
Yes.
So the registrations for the same are yet to be opened, and it will be opening up soon. So stay tuned, and we look forward to having you all again. And before we close, I would also like to highlight our upcoming event, the FPSB India Global Financial Planning Conclave, scheduled to be held in Mumbai on 30th May 2026. And the registrations are now open. You may visit our fpsb.in website and go to our events page and register as soon as possible. So because the seats are limited, and we really want you all to be there. And lastly, for those who would like to revisit today's session or share it with your colleagues, the webinar recording will also be made available on your YouTube channel for broader access. So thank you once again, and until then, stay inspired, stay connected, and have a wonderful evening ahead. Thank you so
Thank
much.
you. Thank you so
Thank
much,
you.
Jatinder. Thank you, Sanya. Thank you,
Thank
everyone.
you.
Bye-bye.